Welcome to our November series of our FD seminars. I'm Chris Rogers, a tax partner here at PKF Francis Clark, and I'm here to talk to you about the topic of navigating a shifting tax landscape. So our agenda today includes an overview of the international tax landscape, including talking about what might be coming next, a discussion of some key international tax risks and concepts, and also an update on the recent transfer pricing consultation. So the current environment, in the current environment, we're seeing that political transitions are reshaping the global tax agenda. So that's been influenced by, tax and trade policies. Governments are facing mounting pressure to increase their revenue amid, an uncertain economic environment, and this is influencing wider tax policy decisions. Additionally, tax frameworks are increasingly being used to support broader goals such as sustainability initiatives and also enhancing national competitiveness. We're seeing a more strategic use of taxation beyond revenue collection. I think tax policy is increasingly being used in that way. We're expecting more scrutiny and policy shifts that could impact upon businesses, cross-border operations, and investment decisions. So what we're seeing, for multinationals and SMEs alike, is that the tax incentive landscape is evolving. EU and other regions are streamlining their tax rules to boost their competitiveness. We're seeing, the impact of Donald Trump in that regard. Finance leaders of multinational enterprises being, those in large groups of 750 million euros or more within the scope of Pillar 2, for example, should be looking at the tax profile and reassessing their existing structures to ensure that they're complying with new minimum tax rules, for example. We're also seeing incentives potentially being redesigned in different jurisdictions to align with these global standards and minimum taxes under Pillar 2. So I think it's important for businesses to be aware of possible incentive changes, investment allowances and sector-specific reliefs that could impact on Pillar 2 calculations, but also impact on cash flow and planning on an ongoing basis. Rising enforcement and digital transformation. So we're really expecting tax authorities to be more proactive in their enforcement and digital oversight. Scrutiny for tax authorities is generally increasing across the board, so that's not just within the UK. You're seeing more integrated government agencies and joined up tax authority departments. The UK has spent significant amounts of money and is going through a process of hiring, I think, an additional 5,000 employees to target the tax gap through increased compliance activities. SMEs should prepare for increased data requests as multinationals, particularly in regard to transfer pricing. Transfer pricing is a top risk for multinationals, but that small and medium enterprises are not immune either. So something to look out for, and more on this topic later. Generative AI and digital tools can streamline tax processes, which is all very helpful, but it also gives tax authorities more information on a more timely basis, and it allows them to automate risk assessment, detect anomalies, and select audit cases with greater efficiency and accuracy. So that's something we are going to see more of as the technology develops. So just to give an overview really of some changes to the UK tax corporate tax code over the last 10-20 years. I'm not going to run through any of these changes in detail. This is just to give you a sense of how government has reacted to changes, be that financial crises or multinational tax avoidance, etc. So just over that period there on screen, 2008-9 through 2015, we saw a real sort of push towards tax fairness on a global level. The UK spent a lot of time investing in looking at the anti-avoidance framework, and the OECD BEPS project really gained some traction. So that this was really sort of the foundation towards future transparency and governance reforms across the board. So 2016 through 2022 saw a shift away from sort of policy design more towards enforcement and transparency. You had the introduction of the country-by-country reporting rules, tax strategy disclosures around transparency and governance, and also the corporate criminal offence rules coming through in 2017, making tax governance a board level issues for all corporates. I mean, CCO applies to businesses of all sizes. We've got other changes coming through there, like digital services tax and uncertain tax positions towards the back end. So 2023, a lot of consultation around Pillar 2. The UK is fully engaged in the project of global tax alignment. Pillar 2 is introducing a 50% minimum effective tax rate for large groups, those with turnover of 750 million euros or more. And will have an impact on incentive structures, tax incentive structures, and compliance across the world for those entities that are within the scope. We are also seeing, HMRC's digital transformation alongside at the same time, meaning more real-time oversight, making governance and data integrity really, central and key to tax strategy within the UK. But that's also true for many countries across the world, and will continue to, develop as the technology grows. So I think, finance directors really need to take a proactive, globally aware approach to managing their tax affairs. That should be the case whether you're managing an SME or multinational tax risks in a large organization, making sure that your tax strategy and structuring investment decisions are aligned with the evolving policy. So key international tax risks. So just running through permanent establishment. Permanent establishment is around, involves, the creation of a taxable presence. So the question of when is a taxable presence deemed to arise in another country, and that taxable presence, means that the arm's length profit attributable to that permanent establishment will be subject to overseas tax. Typically, a permanent establishment is created when you've got a fixed place of business. That might be an office, a factory, a workshop, etc. Or you've got an installation construction project lasting for greater 12 months. And commonly also we see dependent agents, so those being sort of salespersons and agents who are habitually involved in the negotiation or conclusion of sales contracts. So this is an example of an agency permanent establishment risk. So on the we've got the diagram here on which shows you've got a sports agency with a UK limited company in the group. That UK limited company is involved in negotiating sports contracts, player contracts for a number of sports across the world. They're engaged in they also use agents or contractors, employees to work directly with sports people in their home countries. So in this case, we've got an Argentinian agent who is a contractor working only for the UK company. We've got a French agent who is an employee of the UK company, and a Japanese agent who is a contractor working for multiple clients. Now, in this case, the agents lead contract negotiations and often enter into the contracts on behalf of the UK Limited. The outcome in this scenario was that the client had a dependent agency PE in France and Argentina, because in those situations it was deemed to be a dependent agent, because the French agent is an employee and therefore dependent, and the Argentinian agent worked solely for the UK company. The Japanese agent is the one that sits outside, did not sort of cross that threshold of dependent agency because he had a number of clients that he worked for across the board. So in that scenario, because you've got an Argentinian parent establishment, the profits attributable to that PE are subject to local tax up to 35%. And likewise in France, the French profits are subject to French tax at 25%. So it just highlights the importance of understanding at the outset that that tax, the location of your employees and your contractors can really impact on your sort of your PE position and your filing requirements and so on. Withholding tax is borne by the recipient of income but collected by the payer. It's commonly applicable to things like dividends, interest and royalties, but we also see it applying to things like technical services and other fees in other territories. It's increasingly relevant where services or assets are provided cross-border. It can have a very significant impact on cash flow. One thing to bear in mind is that it's deducted from the gross number. It's not a profit-based tax. It's collected on income. Irrecoverable withholding tax is a real cost of a contract, and it comes with compliance obligations for the payer as well. So this is the question of whether you can minimize the cost of withholding tax. So often withholding tax will be calculated based on, it'll be calculated based on the domestic rate. And the next step is then to look at whether there is a treaty, if in the case of a UK recipient, if there's a treaty between the UK and that other territory. And then to look at whether the treaty takes reduces the domestic withholding tax down or potentially eliminates it entirely. To do that, there's often paperwork involved. So that might be a specific local form, or often a UK tax certificate of residence. There could be steps involved in doing so, and that's both on the UK side and also in the local jurisdiction, and ultimately takes time. So it's really important that clients and businesses understand the local withholding tax obligations before they enter into contracts. So just to give you an example of what withholding tax can do in terms of impact on profit, we've got here a high margin example and a low margin example. So let's say we've got £10 million worth of gross income on a contract in an overseas jurisdiction, and in that jurisdiction you suffer 15% withholding tax at source. So in the high margin example, let's assume a profit margin of 60% at PBT level. So that's 6 million of profit. And you are suffering £1.5 million worth of UK corporation tax on that profit, based on 25% rate. So in that example, you then get double tax relief for the lower of the UK corporation tax and the foreign withholding tax, which is the same number, £1.5 million, meaning that there's no UK tax due. That gives you a profit after tax of 4.5 million, so 6 million less the 1.5. Whereas if the contract was far less profitable, let's say a 10% margin, you would make £1 million worth of profit before tax. The UKCT would be 250,000. The double tax relief would follow at 250,000. And as a result, there would be unrelieved withholding tax at 1.25 million. Now, in certain circumstances, that can be carried forward. I won't go into the detail of that here, but just to illustrate that that withholding tax can have a true impact on overall profitability of a contract. So in this example, when you make a 10% margin, it actually results in the work becoming loss-making at profit after tax levels, so £500,000 worth of loss. The key point here is to appreciate that the incremental withholding tax could have been captured at the outset and factored into pricing, and that would have given the business a much better chance of realizing a profit at the end of the day. So transfer pricing consultation. HMRC launched a transfer pricing consultation back in April 2025, and it closed in early July 25. This is aiming to sort of modernize the UK transfer pricing framework and bring the UK more closely in line with countries across the world. So just running through some of the proposals at very high level. Number one, we've got the proposed narrowing of the SME exemption. It's currently very generous, but the proposal here is that the SME exemption would be limited to only the smallest enterprises, being those with less than 50 employees and turnover of less than 10 million euros, and balance sheet of less than 10 million as well. So that has a significant impact on, potentially has a significant impact and brings a lot of enterprises within the scope of transfer pricing that previously wouldn't have been, and results in quite a significant amount of effort and time that businesses would need to invest to make sure that their cross-border transactions take place on arm's length terms. Helpfully, the consultation included a proposal to remove transfer pricing for UK to UK transactions where there's no arbitrage. A lot of businesses already operate as though that exemption is there, to be honest. But it's intended, the proposal here is intended to reduce the compliance burden where there's no risk to the tax, to the tax man. Next one is around the international controlled transactions schedule reporting. Now that could be a significant amount of work for businesses. It requires the disclosure of cross-border related party transactions on an annual basis when filing the corporation tax return. Now that will mean detail in the nature and the value of each of the controlled transactions, the counterparty jurisdiction, the transfer pricing method used, and also some of the underlying functional analysis data. SMEs are expected to be largely exempt from the rules, and the government is currently considering a de minimis of £1 million per transaction type per counterparty per annum. So, something to watch out for. There will be, there is likely to be a de minimis threshold, but for those that are, potentially within the scope of that extension, it may represent a significant amount of work if you're not already capturing that data. So beyond that, you've got sort of the shift to, broadly, it's a shift to data-driven compliance. This is another representative step on that way. The consultation on the transfer pricing reforms officially closed on the 7th of July, following the launch in April. The draft legislation was published alongside the consultation, which indicates that the government intends to crack on fairly swiftly with the reforms. We're anticipating that final legislation will come through in the 2026 finance bill. If enacted, the changes could come in as early as April 2026 or at some point during the 26-27 fiscal year. Businesses are advised to begin preparing for these changes now, as the proposed reforms will, as I said, significantly increase compliance obligations, particularly around the control transaction schedule. The key next step includes monitoring the government's formal response and seeing what comes through in the final legislation. It's worth having one eye on that, but also looking at the data that you've already got in place, documentation, internal systems, so that you are well placed to particularly to deal with the the ICTS reporting element. Early engagement is going to be key, both with clients and stakeholders, to make sure that the business is ready to adapt to the new rules. Being proactive in that regard will really help you to understand the implications of the reforms, adapt your compliance processes accordingly, mitigating potential risks, and ensuring alignment with the forthcoming regulatory framework. So in summary, having a proactive and globally aware approach across corporate tax, but all taxes in general, is key and becomes more and more important as particularly with frequently changing tax rules cross border. Making sure that you're aligning your strategy investment decisions with that underlying sort of movement of tax policy is very important. Be aware of where you have significant people and assets, because tax generally follows substance, and so significant tax liabilities can follow when you've got people undertaking work in a jurisdiction, for example. Consider tax before agreeing any international contracts or pricing. It's much easier to have, appreciate it slows things down, but it's advisable to take the time to find out the incremental tax cost before agreeing a contract, so you can try and negotiate that into your price and ensure that the business is actually engaging in a project that is worthwhile at the end of the day and doesn't result in a loss. Lastly, be prepared for changes to transfer pricing rules. That there's a lot that will potentially come through. It will have a significant impact on the compliance burden for SMEs and and the large companies alike. Data-driven compliance activity is already here in many respects. International control transaction schedule is a further indication that is the direction of travel. Thank you.